Welcome and thank you for joining us for today's webinar. For those of you who may be new to Source Advisors, we've been helping CPA firms and their clients maximize federal and state tax incentives for over 40 years. We are headquartered in Fort Worth, Texas, where we work with accounting firms across the country to deliver expert guidance in areas such as R&D tax credit, cost segregation, LIFO, energy efficiency incentives, sales and use tax, and property tax consulting. Before we get started, just a few housekeeping items. There will be 4 polling questions during today's session. To qualify for CPE, you must answer at least 3 of them and attend a minimum of 50 minutes as tracked by the presentation software. CPE certificates will be sent via email within 3 business days. Additionally, please use both the chat and Q&A features located in the upper right corner of your screen. If you have a question specifically for our presenters, be sure to use the Q&A panel, as we'll reserve time at the end of the session to address as many as possible. Lastly, the PDF of today's presentation is available for download now, should you wish to follow along or reference it afterwards. With that, let's get started with introductions. Joining us today is Imran Syed. Imran joined Source Advisors in 2010 and is currently the Managing Director of Energy Services. Imran is a mechanical engineer by trade and has more than 15 years experience in sustainability and energy efficient buildings. He is a registered professional engineer, a certified energy member, a lead AP, a HERS rater, an NGBS verifier, and Energy Star partner. Also joining us is Matt McKinney, who is our Senior Director, Tax Accounting Methods and Credits. Matt has over 22 years of combined public accounting experience in areas of tax compliance, accounting for income taxes, capital cost recovery analysis, and accounting periods and methods. While Matt has served many different clients for tax compliance and consulting, he has specific industry specializations working with public utilities, telecommunications, aerospace and defense, and manufacturing companies. And with that, I'll hand it over to Imran.
Perfect. Thank you, Anne, and thank you all for joining. Again, as the title suggests, our goal for the next 45-50 minutes is to go over the impact of the Big Beautiful Bill, both on energy, and then Matt's going to cover depreciation and the R&E expenses. There has been obviously quite a bit of changes with the energy tax incentives, both tax credits and tax deductions. But at the same time, there has been some continuity from where the Inflation Reduction Act ended. So as we go through these slides, there are going to be a few slides that covers what the IRA regulations look and what impact did the Big Beautiful Bill have on certain energy tax incentives. We'll start with Section 179D. This is a tax deduction for folks who are probably hearing this for the first time. 179D is a deduction for commercial and high-rise residential properties. New construction, major renovation projects are eligible for a tax deduction. That tax deduction used to be $1.80 per square foot. When the Inflation Reduction Act was made active, that deduction increased to up to $5 per square foot. So there was a significant increase in the tax deduction for 179D. And it still remains the same deduction amount under the Big Beautiful Bill. The major impact, however, is 179D does sunset for projects that begin construction after the 30th of June 2026. So basically, middle of next year is when 179D wouldn't apply. But for projects that start construction prior to that date, all of the deduction amounts and the qualifying criteria remain the same as they were under the Inflation Reduction Act. So there is a little bit of impact that both commercial residential building clients as well as design firms who work on government and non-for-profit projects would be facing because of the sunsetting of 179D. Now, my personal opinion, and 179D has been a permanent part of the tax code since 2006. There's always tax extenders that have extended 179D. We do believe at some point, since this, it's always had bipartisan support, 179D would retroactively be extended. But at the moment, two things to remember: there is that sunset date, but it is only if the construction doesn't start before the 30th of June, and the overall deduction could be up to $5 per square foot. Similarly, on the other side of the coin with Section 45L, which is a tax credit for residential properties. For folks who are familiar with 45L, before the Inflation Reduction Act came up, the qualifying criteria was quite straightforward. With the Inflation Reduction Act, Energy Star became the qualifying criteria to qualify for the credit. The credit, to summarize the credit amount, is $2,500 for Energy Star certification, $5,000 if it's a zero energy ready home certification. So you had a range depending on the certification that a builder pursues. For multifamily projects, prevailing wages and apprenticeship requirements had to be met in order to get the $2,500 or $5,000 tax credit. If not, the credit was limited to $500 or $1,000 per unit. So there's different requirements depending on whether these are single family, townhome, duplex projects, or whether they are multifamily projects. What the big beautiful bill did was the sunset period is June 30th, 2026 as well. The major difference between 179D and 45L being, for 45L, units have to be leased or sold by the 30th of June in order to get the tax credit or in order to be eligible for the credit. This is not a construction start date criteria. This is a criteria for leased or sold units. So the impact for builders basically is for single family clients. If you are confident that the construction will be completed by early next year, 2026, and the homes will actually be leased or sold before the 30th of June, absolutely go after the tax credit. For multifamily projects, again, there may be delays with construction. So you do have to be a little bit careful of, do we really want to go after the Energy Star or the zero energy certification if the project doesn't get completed by middle of next year and you lose out on the tax credit? So these are discussions that may have to happen pretty much right now, just to make sure that the project is truly eligible for the tax credit. Just to summarize again, as I mentioned, 179D still uses the beginning of construction test. There are two ways to confirm whether a project started before the 30th of June or not. One is the physical work test. As long as work of significant nature has started before that date, the project is eligible for 179D. And this is irrespective of when the project gets completed or placed in service. Yes, there are certain requirements about continuity, and therefore a project needs to have continuous construction, and the project does have to get placed in service within 4 calendar years of start of construction started. But again, most projects probably tend to close out or get completed within the 4-year range. The other way to prove whether a project did start construction is the 5% safe harbor rule. So, according to that, as long as 5% of the total cost of the project, again, depreciable costs, if these were incurred before the 30th of June, and then there's going to be construction right after that, the project would be eligible for the 179D tax deduction. For 45L, as I just mentioned, units have to be leased or sold before the 30th of June. Anything after that date would not be eligible for 45L. All right, let's go to the first polling question.
The Section 179 deduction for energy efficient commercial buildings terminates for properties beginning construction after December 31st of 2025, June 30th of 2026, July 4th, 2027, or not applicable.
As we wait for responses to come through, if you have any questions, please do use the Q&A tab, and we'll definitely have some time at the end of the presentation to answer some of the questions.
We have the majority of responses, so you can move forward.
Okay. So we've gone through two tax incentives. One's the 179D deduction, the other one is the 45L tax credit. The big beautiful bill had a clear impact on some of the renewable energy tax incentives as well. Some of these incentives, which really had a huge extension under the Inflation Reduction Act, um, had a few issues where solar and wind tax incentives specifically do have an earlier sunset period compared to the other renewable projects. Um, for solar and wind, and thankfully by now there is a lot more guidance that we have received since the Big Beautiful Bill passed. And so this is the most updated guidance that we have. The key takeaways for any solar and wind project is if a project begins construction before the end of this year. So you still have 2 more months for construction start date. As long as that happens, you have that 4-year continuity safe harbor. So your project can get placed in service within 4 years. You can still be eligible to take the credit. But the more important thing with construction start date being this year is there's no foreign entities of concern restriction that would apply to those projects. And we'll go about what that exact requirements are. If projects start between the 1st of January 2026 all the way through 4th of July 2026, again, you do have 4 years to finish the project, but then the FEOC restrictions would apply, which basically means there's a little bit of more paperwork, and solar and wind developers and installers have to prove that they are compliant with the foreign entities of concern restriction. If projects start after the 4th of July, they have to be completed before the end of 2027 in order to be eligible for the tax credit, and then the FEOC restrictions apply as well. There's no tax credit at this moment for solar and wind projects if they start construction after 2027. So these key timelines of prior to 2026, the 1st of January all the way through 4th of July, and then post 4th of July. As long as builders and developers are meeting one of these three timelines, there is definitely a credit available for them to take. I know Matt's going to cover a little bit about the bonus depreciation, but for solar and wind, the bonus depreciation of 100% would apply. Again, same rules. And the 5 years maker's property would apply to all of the Section 48 or Section 45 eligible properties. Just one more thing to remember. Starting from the 2nd of September 2025, which was a few months ago, the construction start date test depends on the capacity of the project. If a project is more than 1.5 megawatt, physical work of significant nature must have started within this timeline in order to be eligible for the credit. If it's less than 1.5 megawatts, you have the option of looking at both the physical work test as well as the 5% safe harbor rule. So you've got these different test criteria depending on the size of the project. As I mentioned, there's various other tax incentives apart from solar and wind. A lot of them have had the tax credit extended. Some of them expire close to 2036. Some of them do expire at the end of 2030. So again, depending on the qualifying criteria, there's a sunset period that begins. Again, the goal is not for me to go after all of these incentives, but I do want to explain and go over the geothermal heat pump tax credit. Under the Big Beautiful Bill, there's definitely some favorable news for geothermal. As long as construction begins before 2035, geothermal heat pump projects are eligible for the tax credit. under the legacy Section 48, which basically means none of these new rules would apply for geothermal. They would be able to qualify for the tax credit. Um, I may not have mentioned the credit itself, whether it's solar or wind or geothermal. On a baseline level, there's about a 30% credit to the cost of the project, which is generally considered a standard tax credit amount. Then there is the bonus tax credit, 10% if the property is eligible under domestic content, meaning a majority of the system was actually manufactured in the US. And then there's an additional 10% for energy communities, census tracts, so on and so forth. So, generally speaking, you are looking at a tax credit anywhere from 30 to 50% of the cost of the project. So again, it's an amazing tax credit to go after, whether these are for solar, wind, geothermal, biofuels, as well as energy storage projects. Now, the only thing to remember is there's always a sunset period that we'll have to make sure that these projects are still eligible for the tax credit. Similarly, one thing that still extends from the Inflation Reduction Act is the elective pay option. One of the positives that came out of the Inflation Reduction Act was the fact that a lot of non for profit entities, public schools, state governments, local municipalities, and tax exempt entities were finally able to monetize some of these tax credits related to renewable energy sources. That elective pay option is still available as long as the system is eligible for a tax credit. All right, polling question number 2.
All right, under Section 48E, solar and wind energy projects are subject to early sunset compared to other renewable technologies. A is true and B is false.
Again, similar to 179D and 45, well, we truly believe that a lot of the solar projects would be retroactively extended at some point in the near future.
I think we're good to move forward.
All right. All right, one more slide before Matt takes over. I mentioned the foreign entities of concern restriction. This wasn't part of the Inflation Reduction Act. This is completely new with regards to the Big Beautiful Bill. And in a nutshell, what that essentially means is there are a few countries from which uh, a lot of the source material that comes in has to be documented and looked into. The general rule to remember for projects that begin construction in 2026 is that no more than 40% of the material assistance cost ratio can be from countries, and generally for solar projects the main thing is China, because a lot of the solar cells are manufactured there and sourced from China, and therefore the requirements are as long as it's below the 40% threshold, that project is eligible for the tax credit. Now, that threshold does go up to 45% if the construction begins in 2027. Now, what does that mean to us is whether it's a solar developer or wind or other renewable energy sources where the FEOC restrictions apply to, starting from 2026, there will have to be detailed documentation about the source material, and the calculations basically have to show the cost of every asset and every material that goes into this overall qualifying system. And those calculations have to be handy when projects begin, because if the FEOC restrictions or the ratio, the material assistance cost ratio is higher than the threshold itself, that entire project may be ineligible for the tax credit. So for clients who are going into these projects soon, one of the recommendations we've had is have the FEOC calculations handy and have that become part of the proposal phase, just because you're talking about millions of dollars in tax credits that clients might lose out on. So just one thing to remember for projects that start construction after 2025. Right. With that, all right, Matt.
And I will begin my presentation with the polling question because we're going to start talking about depreciation. I was kind of curious to see how this would fall out on this polling.
All right. Do you anticipate your business or clients to increase capital spend due to the renewal of 100% bonus depreciation? A is yes, B is no, and C is not applicable.
And for those that were with us back in the summer, some of these slides are going to look familiar to you. And I'm going to move past those pretty quickly, but hitting on some high notes. So once we get going of the things that we see in and out in our business and some things to make sure that to take note of before the end of the year or before tax return season picks up again.
Looks like the majority say yes.
Perfect. Thank you. I'll move us along. So with OBBA, we know that 100% bonus depreciation has once again come back. It was last with us for a portion of TCJA, and now for a property acquired after January 19th of this year and placed in service, you can get 100% bonus depreciation, assuming that all the other rules apply. The reason I've highlighted the word acquired, that's something that we see a lot or that taxpayers are surprised by, is that it's not only that you place in service the property after that date, you also have to have acquired it. And while some of these rules, we talked about if you were with us, back in the summer, I just wanted to kind of go back over these again. So for acquired property, these are things that, you're not self-constructing, but if you're purchasing this property via contract, you have to look at those contractual provisions and determine if you've actually acquired that property before the applicable date. So, before January 20th, in which case that you would get for this year, you would get, 40% bonus depreciation. So this is something that taxpayers are often surprised by when we talk to them, is the place in service date is only one component of this. Especially when you're acquiring larger properties, say, rental properties or purchasing buildings or your self-constructed machinery and equipment, you have to start looking at those contract dates. Moving along. So we talked a little bit about the acquired property. What about constructed property? We have a lot of clients and taxpayers that we talk to that are constructing either residential or non-residential rental property or other types of, whether it be retail property or manufacturing property. And again, that property may go in service in 2025, and it may go in service in the latter part of 2025. But when that construction began matters. And so in this first year, especially, or even into the second year, when you're dealing with self-constructed property, you're going to have to go back and look and determine when did that construction begin. And so the rules are essentially the broad rule is when manufacture of, construction of a significant nature begins. But most taxpayers use the safe harbor, and that is when the taxpayer pays and incurs more than 10% of the total cost. And these would be your hard costs. So you can exclude land and design activities and other preliminary activities as well. The one thing that I want to make sure that our taxpayers know is what I just said, pays or incurs. That matters. Your accounting method matters. So your overall accounting method, whether you're a cash basis and therefore you pay, or your accrual and therefore you incur, will matter in determining where you are on this test. But again, so if we, just to reiterate, for bonus depreciation, it's not only when you place it in service, it matters when you acquired and or started constructing the property. Moving on. So one of the things we didn't talk about last time, and this came about with TCJA, and largely because of the situation we face now, that you have taxpayers that are acquiring, or constructing what has to be self-constructed property for this rule to apply. And I'm going to note that several times while we're talking about this, because it is very important, is components of a larger property that is self-constructed. So remember, just because you're not doing the construction yourself or manufacturer, for instance, if you are, acquiring, a turbine that has to be built for you, if you have a power plant, and you acquire that via a written binding contract, that counts as being self-constructed by the taxpayer. So this favorable rule that kind of came in, and it didn't make a large impact after TCJA, because it came in with the regulations that would have been on the back end of 2019. And remember, we started looking at the end of September of 2017 for the use of 100% bonus depreciation. And it only really mattered because when you're entering into a new bonus regime, and you have started, the acquisition process or construction of a larger asset, this was a very favorable rule that allows taxpayers to still get 100% bonus on those components that are acquired and or constructed after the applicable date. So we're going to talk through some of the rules. And remember, as we talked about, I see some questions coming through. We will try to answer as many questions as we can, and those that we can't, we'll follow up separately. So if you have a larger self-constructed property that is a qualified property, and you've either acquired this self-constructed property due to a written binding contract, or you are truly self-constructing this property yourself, and your larger asset is not going to qualify for 100% bonus, then there's a possibility that the components of the self-constructed asset can qualify. Now, I'm going to note that, like a lot of the other items that came out with this bill, regulations are going to be needed. However, this is in the TCJA bonus depreciation regulation, so we would certainly expect, considering its prior precedent, that the new regulations that come out for 100% bonus depreciation will be consistent. But just remember, what we're talking about here is old rules, but we expect them to be consistent. And I have way more slides than I'm going to cover here, but I made them a little more detailed just so that you and the audience can have these to help give you some guidance. So, what are the key steps to this component election? Well, the first thing is, what is the asset? That's not always an easy question. It comes down to what the unit of property is, and that rule is different for depreciation than what many of you might think. Unit of property came out with for the repair regulations, but a favorable ruling. And I will say most of the examples in the regulations deal with power plants, shipbuilding, and locomotives. But there was a really favorable ruling or rule in these regulations, and an example that I've included in my slides that's really helpful for those that are doing cost segregation studies on real property. So remember, to use this component election, your larger asset has to qualify. Well, what these regulations say for residential or non-residential real property, and when you have a cost segregation study, now it doesn't say you have to have a cost segregation study, but typically how else would you know? All of the 1245 property that is identified within this, building structure is the larger asset. So that means just because you're building a building doesn't mean that the shorter life property that you can identify within this building. So think about, specialty lighting, certain fixtures, technology type equipment, things that typically get found within a cost segregation study and go from either 39 or 27.5 until 5 years or some other shorter life property. All the items together that make up everything that you would find that would be 1245 property through such study is the larger asset. So that's the first favorable item, is now that if you've done this study on this non-residential real property rental, the components of that can potentially qualify for 100% depreciation, bonus depreciation, even though you started building this property, say, in November of 2024. So once you've identified the larger asset, next you have to identify those components. And I'm going to tell you that the regulations, if you go through the regulations and the examples, it's not overly technical on the identification. The examples are pretty straightforward. The problem is, there's going to be a lot of detail necessary to identify which components, had you acquired prior to 1/2025 versus the components that you acquired after. There's got to be cost analysis in a lot of cases. Remember, the examples that were given in the regulations, for the most part, I'm building a power plant, and I've acquired from XYZ company a turbine. Well, identifying that turbine that's under a totally separate contract from the power plant is going to be relatively easy in comparison to identifying all the 1245 property built under one general construction contract. So you can see where this is not necessarily a technical exercise as much as it becomes a math and accounting exercise. So how do you make the election? You have to make the election in the year the larger property goes into service. The regulations are not very detailed as to how you make this election, but my advice would be to include more information versus less. But you do have to state whether or not you are going to, or whether you're including all the components or just some of them. And so I've said a lot there, but I'm just going to kind of reiterate this. Essentially, what this rule does is when you have self-constructed property, and again, I said I was going to say this several times, the property has to be self-constructed. It cannot be something that you go out and acquire from a store or online somewhere. It has to be something that you have acquired that's not off the shelf. So either you've acquired it via a construction or manufacturing contract that is written or binding, or you are constructing this property yourself. In that case, for the components that you acquire, and remember, we talked about a few minutes ago, acquire comes down to either when you under your accounting method, you've acquired it via the construction of the property. So when you've paid or incurred 10%, or the contract that you have. So in my case with the wind turbine, if I'm acquiring that and it's via contract and it's a component that it isn't going to be constructed for me, it matters on when the contract, if it meets all the, was binding, and if that was binding before 1/2025, then I'm not going to get that component. But if that component was acquired after, meaning if it was self-constructed, or if the contract was, after January 19th, then if that component otherwise meets the test for 100% bonus depreciation, then I can take 100% bonus depreciation on that piece of my larger asset. So that's what this rule is about. Again, we're still going to need regulations to confirm, but it's a high likelihood that these regulations would be the same. There's just not a lot of guidance out there, and there's not a lot of articles written because this was something that came, in under TCJA very late, but we think can be, since we know about it and ahead of time, this time it can be very powerful to those that are self-constructing larger assets. What's important here, what's going to be really important to this is, again, talk about, you have to identify what the larger asset is. Then you have to be able to identify cost-wise what your components are of that larger asset. So in the world here of source advisors, a lot of times that is going to be, assets that we identify via cost segregation that are 1245 property. So the 1245 property, everything within that building is the larger asset. Well, now I have to figure out, well, of that larger asset, which components were acquired after January 19th, 2025. And that's where the documentation exercise becomes significant. I think for taxpayers, the more data that you have, the better of an analysis you can do. And I think, again, the IRS doesn't tell you how to do this analysis, but rather, I think it's going to come down to every taxpayer is going to be different. But I think the more records you have and the more precise details that you can provide on how you identified your components of that larger asset, the better off you're going to be. So I'm going to move on from the component election, but I'm sure we're going to get plenty of questions and we're happy to answer those later. Now, I'm not going to talk through this example, but I included it in the slides because this example goes through in significant detail how this election works in a real property example. Quickly, as I still have quite a few slides to get through on 174 guidance, I did want to talk just briefly again on qualified production property. This is something that we have to get additional guidance on. And as you know, the government's shut down. There's still a significant list on the other, items under OBBBA that the IRS has to get through, as well as just getting the tax return forms ready for the upcoming filing season. So if you think about with TCJA and then, a normal setting or a more normal setting, it still took years to get depreciation guidance out, even though a lot of that was copy paste. Here, this is a new part of the statute. And so it might take a little bit of time, but just as a refresher, this applies to non-residential portion of new construction that is used in a qualified activity. So think manufacturing. But it also includes property that you acquire if that property had never been used by anyone in manufacturing again before. So if you think about if you acquired a retail location, turned it into a manufacturing location, then assuming that you meet the substantial transformation test, then this would also qualify as long as you meet the other date test, things of that nature. But again, we think this is big for taxpayers. The unfortunate issue is that for now we do need guidance. So if you do have taxpayers where this is significant and they have property that can qualify now, my advice would be to stick close to the statute. And remember, when it comes to depreciation items, these are methods. So if you have to change it later, typically you would be allowed to do so under a method change. And usually when we get depreciation regulations, we also get new method change guidance following that. So I think, the advice would be stick close to the statute and then chew it up later. But again, this is something that is going to be significant for taxpayers. It's just going to take them a little bit of time to get us guidance. Okay, we're moving on beyond fixed assets and on to the bill's impact on R&E expenses. So we knew in the summer that, we got to go back to expensing 174 cost. I don't think any taxpayer or a practitioner ever thought that we would see capitalization, even after TCJA, that there's enough runway that Congress would repeal or find a way to keep us from having to capitalize those costs. Well, that didn't happen, as everyone on this presentation knows. And we knew in the summer that, okay, in 2025, we get to expense these costs again, for costs incurred in tax years after beginning in 2025. And then for small taxpayers, generally $31 million and under for 2025, could go back and expense these costs. Well, what we didn't know was how we were supposed to enact these rules. And it took us a while to get guidance, but Rev Proc 2528 that came out in late August provided us the guide rails for implementing all of the new legislation under 174 Cap A. And here's polling question number 4. And you might be on mute.
Sorry about that. Will you be amending tax returns to retroactively apply the new Section 174 expensing rule? A is yes, B is no, C is not applicable.
And I'll go ahead and just start going over a few things before we move on, because again, I have more slides than I'm going to get through, because I know we want to leave some time for questions. But this is something, as we start moving through these slides, I want to remind everyone, timing matters. So there's a little bit of a short runway to get some of these items done.
All right. So 96 of you, 32% say yes. 164 of you, or 54% say no. And 13% say not applicable.
Okay. That's a little surprising. I actually thought there'd be a lot of amending of tax returns. So the Rev Proc 2025-28 gives us guidance for how do we implement the new statute for 174 Cap A to return to expensing 174 cost. It provides the method changes. It provides the elections. It also provides the method changes to on how we deal with things that aren't changing. The items under TCJA relate, and for that period that TCJA was still in effect, and then also foreign R&E expenses. Remember, what we get to deduct is only going to be the domestic. So I'll start with the small business guys. So remember, $31 million of gross receipts or less, based on a 3-year average as of 2025. So, those taxpayers have the option to go back to essentially, 2022. If we're thinking calendar year taxpayer, they're going to go back to tax year 2022, after December 31st, 2021, and start deducting in that year. So it gave them a few options as to how to do this. So those taxpayers, they could do nothing. They could wait and just true it all up going forward, or they could amend their returns or file AARs if you're a partnership under BBA guidance for each year under the TCJA regime. So we've been under that regime, you were going back to for most taxpayers, 2022, 2023, and then amending 2024 if you didn't catch it in time to implement these rules. But remember, these came out in late August, so there's a lot of taxpayers that were going to be amending. There was a short runway, matter of days for a lot of taxpayers, where you could have filed a method change and to retroactively apply without going back and amending to take the deduction, you could have filed a method change. That method change is now going to be only available for those taxpayers for 2024. Essentially, you need to be a fiscal year filer and still have a return out there. The guidance also allows small taxpayers to make or revoke 280C elections as necessary on their original returns. But the thing, while we said during the polling question, the thing I want to reiterate here is you can see from the slides, you don't have a lot of time. You essentially have, the earlier July 6th of 2026 or the expiration of your normal statute of limitations. So timing is key on this. Moving on. So what about everyone else? And so the one thing I want to clarify when I say guidance for all taxpayers, this means taxpayers that are either, don't make the cut for being small business taxpayers, or those taxpayers that chose, to wait and do this prospectively. So if you were a small business taxpayer and you either filed the method change or you amended or will be amending returns, it doesn't mean you have to do it twice. But it does mean that all taxpayers are going to have to do something. The one thing about this, even though it's a new statute, which for me as someone that is that's worked in accounting methods for quite a many years, typically new items you don't need a method change, but the IRS is requiring all taxpayers to conform to the new rules via method change. So what does that mean? So for tax years, beginning for December 1st, 2024, for those expenditures and that would be deductible under 174 Cap A, it's going to give you options under this RevProc. How do you go about immediately deducting them? If you want to, even though this isn't something that I hear a lot, how you can elect to capitalize. And then also, to your choice, how do you recover your remaining basis on those capitalized expenditures from TCJA over 1 or 2 years? So it gives you options here. So the one thing about this RevProc and the statute, there's a lot of options to work through, and unfortunately not a lot of time to work through them. Good news though, under this guidance, while it said everyone is going to have to do something, if you're a small taxpayer and you went back and you amended to retroactively apply these rules via election, this doesn't apply to you. But if you're a large taxpayer or a small taxpayer that has decided to move forward and do this prospectively, everyone has got to do something. They got to file a method change. Well, luckily, this is going to be a statement change and not a full Form 3115. Now that is for the rule, applying the new rules under 174 Cap A, which is accounting method change number 273, and this is going to be made for the 2025 tax year. So my expectation is after 2025 tax years are over, we're going to get new guidance for what you do if you still didn't get it done, or if there's tweaks that have to be made. For foreign, what this guidance also did is it did separate out. Before we just had one method change, which it was number 265. Now it splits out into 3. So the rules for dealing with 174 Cap A, effectively how do I go back to expensing domestic R&E, is going to be under number 273 of the automatic change RevProc, and then for changes for foreign is going to be under 274, and then 265 deals with TCJA rules. And there's a little bit, I do caution, taxpayers that maybe have some issues, with capitalization that maybe, they wish they had fixed, or they might think they should have fixed. Method changes for that in 2024 were easier to make than going forward. Remember, this guidance is essentially assumed that everyone was following TCJA perfectly. So if you have some things that you wish you had tweaked, or changed just slightly or maybe, significantly, then you may want to think about, have to put a little more thought into this, because there is what I'm going to say on the next slide is I'll get to this in a second, but there are limited ability to get audit protection under these changes. So it's a little bit different than what's usually perceived as audit protection via accounting method change. And then there's multiple options, but there's also, you still have to worry about the 5-year rule. So some of these options allow you to waive that 5-year rule, meaning that for accounting method changes to be automatic, you can't file the same change for the same item within 5 tax years. So if you have things and you're thinking, hey, I'm going to file the 265 and the 273, and I'm going to clean up the back years, and then I'm going to deduct and going forward, well, it's going to give you a little bit of a hiccup there, and it's not going to allow that. It would allow it for 2024, but it's not going to allow those things to go both ways in all cases in 2025. So just be careful, give it some thought. And there's over 60 pages to this Rev Proc, so please reach out if we can give you some assistance. I think the key is with this is, remember, it gives a lot of options, but it doesn't give a whole lot of time to make those options. So just think about that on the window you have left before July 6, 2026. And with that, I have sped through some items on depreciation and 174 guidance, and we're going to go through and answer some questions. So, Imran, I'm going to send it for you for a minute.
Yeah, I've got a couple of questions, Matt. Let me take care of that, and then there's a few more for you. The first question, does construction starting by June 30th? Oh, I guess the question is, would vertical construction or foundation work constitute a construction start date? And the answer is yes. Under the physical work of significant nature rule, preliminary activities like land clearing or permitting, that's not eligible. But if it's foundation or even excavation for the foundation work, that's all part of construction. Therefore, you can use that towards the construction start date rule. Can you talk about the tax credit on commercial solar projects and when the 5-year makers rule apply, or when a longer life applies, and what the longer life would be for the taxpayer? This is a great question that I do not have a definitive answer yet. We are waiting on final regs, hopefully to provide us with some more guidance on this. But here's my quick 1-minute response to that. Remember, solar energy property gets the 5 years maker because it falls under the definition of a Section 48 qualifying system. So if you look at the maker's recovery period or the asset class life table B1, you notice this note that says any energy property under Section 48 gets a 5 years treatment. Now, what happens post 2027 when solar is not eligible under Section 48? You wouldn't be eligible 5 years. So I do believe that if it doesn't fall under the definition of a Section 48 tax credit and therefore not eligible for the credit itself, that the 5 years makers should not apply. And I've gone through that entire table, and the only closest thing I found was asset class life. I believe it's 49.14, electric utility and generation, which has a 20-year makers period. Again, this is just my opinion at this point. But if solar or wind, for that matter, doesn't fall under the definition of Section 48, there's a good likelihood 5 years wouldn't apply, and they would be looking at a 20-year recovery period.
Yeah. And I'm going to jump in on that one a little bit, Imran. So the other thing that would matter is, so essentially the energy property got its own carve out. Yeah. Is now then what asset is it part of? Is it, does it become building property if it's for the maintenance and production, maintenance of the building, or does it get included in some other asset class, if it's, essentially part of machinery or equipment, so in case of solar, if you were powering, a data center or something of that nature. So I think what would happen is you essentially go back to looking at how the asset is used. If it's used, for the maintenance of the building, or if it's used as part of the activity itself. So either it falls in an asset class or it falls in an activity class. So that one's going to be interesting to see if we get further guidance. I'll jump into the next one. I believe this question goes to where I was talking about, projects, acquisition dates, or, for contract, via binding contracts or for self-constructed property. But the question was, are you saying that depreciation applies when the project started, constructed for self-constructed projects, not when it's placed in service? No, that's not what I'm saying. Depreciation starts when an asset, for the most part, when it has to be acquired and placed in service. So you have to have both. So your asset is still going to start depreciating when it's placed in service. What I was talking about is which bonus percentage do you get? If you acquire the asset before 1/2025, meaning you started constructing it, which for most taxpayers means you've paid or incurred more than 10%, or you acquired the asset under a written binding contract before that date, that means your bonus depreciation falls under TCJA and not under the new legislation. So just to clear that up, place in service still is, usually when you start depreciation, but you also have to look for bonus depreciation when you're changing regimes, when you acquired the asset. And that's what that comment was considering. Is there any guidance on manufacturing food, imported ingredients, or get transformed, but the ingredients have been processed from plant prior to shipping? So in this, no, I believe this may go to QPP as question. The problem is there's no guidance whatsoever. And so the substantial transformation, the only guidance that we have is under the subpart F rules, and it's really vague. So, I can definitely say something along the lines of repackaging will not qualify. And then obviously if you have something where you're making something from ground, point A to point Z, you know that's going to be substantial. What about the things that are going to be riding the line? That's the part we really need guidance on. And I think in your case, in the case of this question, it may be one of those things that we have to wait for guidance. And the other was just the next question was just a clarifying. Hold on, I'm just going to take a second to read the next question here. The client has a home office which was built in 1983. He now wants to expand the office. Will these expansion costs qualify for 100% bonus depreciation? There's a whole lot of things within that question that are unknown. First of all, if this project is going to take place, meaning in the future, meaning nothing has occurred, well, then you would be within the new guidance for 100% bonus depreciation, meaning you couldn't have acquired or started constructing this prior to 1/2025. Now, if you did, if it had already started, then that hurdle has to be dealt with first. Well, then the other thing is you have to have cost within that expansion that would qualify for a shorter life. So if the answer to both of those is yes, meaning the construction is going to start after the fact, or you're going to have items that will qualify, then yes, you should have an opportunity for 100% bonus depreciation. And then lastly, can you just discuss the statement that needs to be attached when amending for 174. There's it's a little tricky, but we do have, if you want to contact us or we can contact you, I do believe we have the ability. The RevProc gives you a pretty good listing as to the items that you need to convey. But I believe we have some examples that we could show you how, what we think that statement would look like. So that might be easier. So we can reach out to the person that had that question.
Are there any other questions? Well, thank you, Imran and Matt. And if you qualified for CPE, those certificates will be emailed to you within the next 3 business days. Thank you.